This meeting is being live streamed on Newham's YouTube, so welcome to everyone viewing online. My name is Daniel Mark Carr. I'm the new chair of the committee following a recruitment process through the latter half of last year and endorsement at December's council meeting. There are some other new faces here with us this evening. Shortly, I'll ask everyone to provide a very short introduction. But before I do, some meeting hygiene and etiquette, if I may. So anyone attending remotely this evening must turn on their camera when speaking. And please note that the chat function on Zoom will not be used for questions or answers throughout the agenda, but you may communicate through that chat function with the clerk. For those of you here in person in the chamber this evening, please indicate your wish to speak by raising your hand. People online should raise their virtual hand and we will monitor the screen. Throughout the course of this meeting, please ensure that all questions, including follow-ups and supplementaries and any answers, are addressed to myself as the chair. And may I remind members and officers to speak up, speak clearly, project your voice in the chamber so that the clerk and the public can hear us all as clearly as they can. And do please let me know if there is any issue with sound. So in the December council, it was also endorsed two new independent members, Joanne Pitt and Alexa Ngini. And I'd be grateful if we could start this evening's meeting by everybody present introducing themselves by name and job title. And in addition, for this meeting, I would like to ask that you reintroduce yourself the next time that you speak on an agenda item. So I will start with the nearest member on my left in the front row. If you could share your name and job title, please.
Yes, my name is Joanne Pitt and I'm the Senior Policy Manager at SIPFA, and this is my first meeting. So thank you all, and I look forward to working with you.
Thank you very much. Absolutely.
Thank you very much, Chair. My name is Melanie Onovo. I'm Councillor for Maryland Ward. It's very lovely to meet the new independent members this evening, and thank you all for being here.
Thank you very much. We'll go to the back row and then come round.
Councillor Terence Paul, Vice Chair of the Audit and Governance Committee, Stratford Ward Councillor and interim Vice Chair of the Crime and Regen Committee.
Thank you.
Councillor Belmont Adway, Councillor for Custom House.
Councillor Anthony McCormick, member for Royal Housing.
Wonderful. Thank you, Andy.
Councillor Alan from Guildford, the Guildford Ward.
Thank you very much.
Alexa Ngini, independent member, and my job is I am a senior consultant at Inner Circle Consulting.
Thank you.
Thank you. Andrew Ward, I'm the Director of Finance Management here at the London Borough of Newham and Deputy Section 151 Officer.
Mania Hall, Head of Finance, Financial Controls and Pension.
Thank you.
I'm Arnold Meager. I'm Head of Law for Housing, Litigation and Employment in the Legal Services Department.
Thank you very much.
Pauline Egan, Democratic Services Clerk to the Committee, and at the moment, Chair, members joined us online.
Right. Okay. Well, thank you very much. Thank you all for doing that. Look, before we turn to the agenda this evening, I just want to acknowledge that the agenda only has one substantive item, which will allow ample time for questions. And with that being said, and I'd like to thank Councillor Paul for the reminder of this, I want to make it clear that no question is a silly question. If it's on your mind, it's very likely to be on someone else's mind. And it's only through asking questions that we can get transparency and answers for our communities and our residents. So please do ask away. So turning to the agenda, item 1, apologies for absence and substitutes. Are there any apologies for absence from members?
I haven't received any apologies. Chair and Councillor Chowdhury will be joining us online.
Thank you very much. Item 2, declarations of interest. So to those members who are present physically, are there any disclosable declarations of interest this evening? No? Thank you. Item 3, minutes of the last meeting. These are pages 13 to 24 of the agenda pack, and I assume that you'll have read them prior to this evening. So members are requested to consider and agree the accuracy of the decisions and minutes of the last meeting of the Audit and Governance Committee, which was held on the 5th of November 2025. Are there any matters of accuracy? No? Okay, and are the minutes agreed? Agreed. Thank you very much. Item 4, actions log. That's pages 25 to 26 of the agenda pack this evening. The committee is asked to note the contents of the action log. Are there any questions on the actions log?
Chair,
Councillor.
through you, 2 points really, Chair. On action AC 279, the committee from the last meeting requested a plan of action on 55 days for the turnaround. On the Chair, would it be more appropriate, as well as the report to the Housing Scrutiny Committee, and that they consider what decisions and actions they could take? Because it's strictly, you could say, within the area of responsibility of the Housing Scrutiny Committee to look at the issue of voids. And the other matter, Chair, on the note, and it really reverts to the minutes. There was a comment on the minutes, which is 7.18 of the minutes, where the Director of Education was reminded that all schools who have a limited assurance audit should come to the committee and account for their audit. I wonder, Chair, could we add an additional action to the action log that by your authority, Chair, you write to the Director of Education for her to remind all schools, all maintained schools, of their obligation to attend this committee when their schools are noted for a limited assurance in any future inspection reports, Chair.
Thank you, Councillor. So to your first point, yes, I would be inclined to agree that that should be moved to the Housing and Scrutiny Committee.
What could come here, Chair, for information, that also could go to the Housing Scrutiny to allow them to follow for their work plan.
Yes, is that noted, Grant?
Yes.
Yes, and to your second point, yes, I'd be more than happy to write to the Director of Education, and we'll rely on the clerk's
Yes, we'll
support
sort that out.
in doing so in the foreseeable future. So to members present in the room, may I see by show of hands, is the report noted? Noted, thank you. So we'll now consider the substantive agenda item. So item 5 is the draft Treasury Management Strategy Statement, the TMSS, and the Annual Investment Strategy, the AIS, including Q3's 2025-2026 update. I'm allocating 60 minutes to this evening, and I'll invite Andrew Ward to introduce the report, which will be followed by member questions. And Andrew, if I may, for the benefit particularly of new members here this evening, might you be so kind as to provide some additional background and context to the report?
Certainly, Chair. Yes, thank you very much. May Chair, just one moment. I do have some finance colleagues looking to join the meeting via the Zoom link. They're working on it. I can just ask the clerk to make sure they've got that link. Thank you.
Just sent it out.
Thank you.
Thank you.
Okay. So to the report, this is the Treasury Management Strategy Statement. In fact, it's the draft Treasury Management Strategy Statement for 26-27 and the Annual Investment Strategy as well. So this is the latest iteration, if you like, of the TMSS, because a report that many longer standing members of Audit Committee will be familiar with the look and feel and the format of this report, particularly the Prudential Indicators Index 1. So it's an important part of our budget setting, and our budget setting papers come to Cabinet in mid-February and to full council in the end of February. And it sets out the borrowing limits for the council as one of its functions, and shows the indicators, which are a good way of monitoring and seeing that we are working and operating within those limits for the year ahead. It's then followed later in the year. We will sending to Audit Committee sort of an outturn version of the report. So that's sort of backward looking, and that will be for the 25-26 year, which obviously is still in motion, and sort of comparing how we performed against those sort of limits and prudential indicators, or not limits but indicators on Treasury activity. There is a mid-year report, which, apologies to new members of the committee, but other members will recall came to Audit Committee back in the autumn. And then, of course, there is the actual sort of strategy statement, which sets out the new indicators for the year ahead. And that's to be, that works well in conjunction with the the capital plans for the year ahead and the capital strategy, which itself is sort of updated on an annual basis. There's no question the council has a large capital programme made up of lots of individual schemes, and necessarily those schemes and projects are unlikely to be sort of concluded and finished in any one given neat financial year. They do stretch over a number of financial years. This report comes to Audit Committee really primarily for the purposes of scrutiny, so that it can be challenged and scrutinised. And we welcome all of your questions, of course, and that will help us develop it and improve it for inclusion in those February papers, as I discussed. It's updated with the figures as of towards the end of the autumn for 2025. Sorry, and we can expect that the final version of this Treasury Management Strategy Statement will see some changes to these numbers, because as we go through a budget setting process, which we are in the middle of, we are looking at what the council will choose to do in terms of its capital programme. So the draft budget included an appendix on the capital strategy, sets out the process that's going through. And to summarise that, if I may, it talks about reviewing the capital programme to see if there are projects which are no longer appropriate or necessary that councillors can take action to remove from the capital programme, and a real focus to look at schemes which will generate a return on investment and perhaps contribute to some of the savings in the revenue budget for 26-27 and beyond. There is, as I said, it's a large capital programme. There is still there are many, large capital programmes and master plans on a self-financing basis. So regeneration type schemes are included in the capital programme. But as we work that through, that will mean some shift in some of the numbers presented in the prudential indicators in Appendix 1 of this report. So I won't go through all of them or anything like that, but Table 8 in there shows the borrowing as a percentage of the general fund. So if we allocate slightly less money to the capital programme for 26-27 than we had previously outlined, you could expect to see those numbers shift and reduce actually the percentage of the general fund going towards borrowing costs reduced as well. But it will be a sort of marginal shift as opposed to some sort of sea change in those numbers. Of the other appendices to the report, we've got the Appendix 2, which is a schedule of non-treasury loans. So that involves the money loaned to the wholly owned companies of the council. And again, longer standing members of the committee will be familiar with that format, and that's the latest update on those numbers. And then Appendix 3 are those specified investments that the council could choose to utilise when it comes to making investments. I realise I've mainly talked about the capital programme and then the borrowing required to fund the capital programme. There isn't a lot of investment cash out there for the council. Those investments that we do make are kept very secure, and we've only used we essentially loan money back to the Treasury and receive a sort of overnight rate on those funds to date. But those are the sort of ones we could choose to use under the annual investment strategy. But I just want to stress that there's not a lot of activity, certainly nothing exciting going on in that space. Is that okay, Chair? Or...
That's okay for now. But before I jump to members' questions, a note for the minutes. Could we please ensure that the independent members receive that mid-year report that Andrew referenced?
Yeah, we can go back and from earlier from 2025.
Mid-year report that other members will have received. If we could just ensure that independent members receive that, that'd be helpful. So before I pass to questions for myself, please, which I hope will provide points of clarity. firstly, could you summarise for me, please, the key ways in which this year's position differs from last's, both positively and negatively?
I mean, it's been a reasonably consistent picture of increased borrowing to finance the council's policy aims, and the main one that comes through there is the housing and regeneration, the creation of new homes and the regeneration around that. I think we've seen again a sort of consistent picture in terms of capital spending from this year to last. And I'm rather struggling to pick out sort of the significant changes. I feel it's been a consistent picture really on borrowing. I mean, obviously the levels of borrowing have increased, so it's gone from 1.4 billion in terms of total borrowing at the start of the year, and we've taken an extra 40 million pounds since that start of the year. So that's happened during the year. We don't borrow in advance of need. We work very hard to limit the costs of borrowing, and only borrow on the basis there. Again, it's consistent in terms of our cash treasury position. Grateful to some of my treasury colleagues on the call as well, but we manage it with a 50 million pounds sort of balance on our cash, and that's remained consistent since last year as well, Chair.
Thank you. That's very helpful. And another point for myself, if I may. This is a draft document, right? And you reference the capital programme, and that strategy is also under review, as I understand. Could you clarify when you expect that programme to be finalised, and how confident you and other colleagues are that assumptions in the TMS will hold?
Okay, certainly. So we published a set of draft budget proposals on the 22nd of December last calendar year, and that was received by Cabinet and approved by Cabinet for purposes of stakeholder engagement. And here we are on the 8th of January. The capital strategy appendix in that did not specify we will not be doing these schemes and we will be doing these schemes. It did talk about the types of review that we were looking at. So looking at schemes where they've entered the sort of capital pipeline and programme, but not very much has happened on policy priorities will have changed. So those kind of projects being reviewed to avoid. There is, of course, the chance when you delete something from the capital programme that money may have been spent in the pursuit of creating or purchasing those assets, and that would result in an abortive cost for the council. So I just wanted to quickly make that point. But it's also trying to pursue, or it would be recommending adding schemes which help deliver our savings. So supported living schemes, for example. So we may be able to purchase or acquire, same thing, properties where we can support more sort of vulnerable clients of adult social care, and maybe able to acquire more units of accommodation to help with our temporary accommodation financial pressures, and basically through using our purchasing power and capital budgets create sort of revenue savings in our day-to-day spending next year. I don't think any of that will come as news to sort of certainly to councillors who are also on the budget scrutiny position there as well. But there is a focus in that document budget. There is a focus that we are looking for schemes that will save us money and improve the financial position of the council. It's not intended to be, there's no big sort of new policy pursuits suggested by that document. So we are in a process of engagement on those proposals. We are working closely with the Budget Scrutiny Commission at the moment through a series of meetings with them, and the final budget proposals will be published in good time for the Cabinet meeting on the 17th of February. But of course, the final budget the Cabinet would approve the budget to go forward to full council for a vote at full council it will all be part of that. Okay, sorry, colleagues, just remind me, Chair, if I can come back to your slightly earlier question, just a change in what's happened differently from last year. Well, in some ways, we've continued where it's economically advantageous and we have the opportunity to refinance and get rid of, if you like, some LOBO, lender option, borrower option loans that are a legacy issue from many years ago. So when the opportunity arises, and it's, it makes good financial sense to do so, we have reduced the level of this. I think that's evident.
Okay, thank you. And sorry.
I was just going to say, when you do invite member questions, we have Councillor Chowdhury's got.
Councillor Chowdhury. Okay. We'll come to Councillor Chowdhury first. Just one more moment, Councillor, if you may. So a follow-up to my query on the capital programme being a draft. I just want absolute clarity here. Obviously, that programme is large. So if there were to be material changes to it, how quickly would those changes kind of flow through into an updated position and be reported to the members here?
So reported to it. So we could take the opportunity at next audit committee to provide more information, certainly. Of course, the cabinet and full council papers are public documents and published as well. I mean, I don't know if you'll take assurance from this or not, but the draft budget capital strategy is sort of outlined what we were looking at in terms of changing the capital programme. There's nothing in there that suggests we add things. If you delete certain schemes on the pipeline, the impact of that would be detailed in that cabinet paper for the 17th of February. So I just encourage yourself and other committee members to look at that. We could certainly, make sure we don't, provide that information at that time to yourself and the rest of the committee.
I'd appreciate that. Thank you. Okay. So now moving to questions on the report, and I will just start with Councillor Chowdhury, who has his virtual hand up and is joining us remotely.
Thank you. Just a question on the reference to £2.9 million overspend. Can you talk a little bit more about what that is and what the total amount of the Treasury Reserve is, and how much is remaining in the Treasury Reserve? It'd be good to get a bit more detail on that.
Chair, could I just ask it with questions if people could just pick out the paragraph number?
Sorry, it's 4.1.2 under key considerations and proposals.
Sure. Okay, so we have, of course, a borrowing budget, which we estimate as part of our budget estimations each year. And some years we come under that, and some years we'll go over that. In the years that we go under, we have generally, although there is a choice to be made by the Section 151 officer at that point in time, we have generally put that underspend into the Treasury Reserve, which I think from memory totals are roughly around £13 million in terms of our reserve. It is detailed in our information on reserves elsewhere. And I mean, the reason for that is there's a lot of uncertainty with the timing, I think, of the capital programme. So prepare these estimates and go through this process. What will we need to borrow? What kind of budget will we need to have? And there certainly is growth in the budget proposed for next year to cover the increased cost of borrowing. So we'll need to see it outturn just how large that overspend actually is. I did say earlier we've only borrowed £40 million because we do closely manage our cash position. I feel comfortable saying that's a sort of a pessimistic or prudent estimate in terms of an overspend on the Treasury budget. It may be much less, indeed it might come slightly in, but we were basically sort of using that Treasury Reserve to manage those overs and unders from year to year.
Mm-hmm.
Does that answer your question, Councillor?
Yeah, thank you.
Okay.
Thank you very much. And so to those in the room, just a small reminder, if you're referencing somewhere in the report, to Andrew's point, if you could include the section and subsection at the beginning of your question. Alexa.
I have sort of, I guess, two questions, and members in the room, forgive me, because you might all know about this, but I haven't interacted with Newham in quite a while, so I don't know what the stage of this is at. But as far as I remember, the council was considering applying for EFS.
Yeah.
I don't know what stage of where we're at with that, but I just sort of had a question overall about the way that the like borrowing strategy of the council is set to interact with that EFS when, let's say, it is awarded. And I guess my question is, so if the EFS application is approved, how do officers expect to see that interacting with all the assumptions within the Treasury management strategy about, like, for example, as far as I remember, I think Newham has, correct me if I'm wrong, Andrew, but like relatively high levels of debt from a London Borough perspective. So I just wonder if there's ever been an assessment on the capital financing requirement and future headroom should EFS be approved, and like how that affects affordability assumptions.
Okay, thank you. So EFS, for listeners, etc., refers to exceptional financial support, which is essentially a scheme governed by the Ministry of Housing, Communities and Local Government, MHCLG, and it requires Secretary of State approval. I think I'm getting all these details. It has an agreement in principle for £51.2 million of EFS approved for the current financial year, that's 25-26. Where this differs from the EFS offered to some other councils is that this money is not being loaned to us by central government with interest charged. That's not the case for Newham. It is being found from selling our assets. So it's a capital disposals programme to raise those funds. The support, if you like, in terms of the exceptional financial support, is the flexibility on the legislation, which allows us to actually use capital proceeds or receipts to fund our day-to-day spending. I want to be really clear, and many of you will have heard this statement before, that is not a sustainable strategy for funding the London Borough of Newham. And I think, if I may, your quite reasonable sort of point is that can you justify sort of increased borrowing at a time when you can't, make your revenue budget balanced?
Yeah.
And a very reasonable point that is. So looking ahead into 26-27, and part of the draft budget papers that Cabinet received on the 8th of January, I've already spoken about. Given the thorough funding review and the changes to local government funding, and the fact that that sort of has strongly indicated how much money the London Borough of Newham will receive next year, but also the following 2 years, so a 3-year settlement essentially. Given that we are in a position where we have not approached MHCLG for more EFS for the year 26-27. So essentially able to, it's rather tight, but set a reasonable budget that balances income and expenditure for 26-27. But I mean, just taking it back slightly, because I think it's a really good and reasonable point. The capital programme, and I asked the question about the changes from year to year. It remains pretty consistent from last year. We're not embarking or adding to the capital programme for schemes that aren't. Sorry, there was one thing I didn't say. There are of course some business critical investments you've got to make, some sort of health and safety type issues. That a building will not collapse on employees or residents or anything awful like that. Of course, we make allowance for some limited capital investments, but business critical and those that would produce a return on investment and actually help improve our revenue position. And I think there are examples of that for our sort of Newham Living programme, for example, where we are, and in temporary accommodation as well, where we have used capital funds to go out, buy blocks of flats essentially, and then use them so we can place vulnerable residents in need at a cheaper cost than we otherwise could. So I think our conversations with MHCLG, we've got applications for EFS, and we've got the agreement for principle is something that they considered, looked at, and I think there was a compelling sort of case to say, historic borrowing is historic borrowing. We can't sort of suddenly unwind all that position, but the addition, much of the addition to the capital programme was about acquiring units and helping the financial position, and I think they took that into consideration. Certainly we received challenge on this point here, also from the new Independent Transformation Board as well, which reports back to MHCLG and is part of that whole conversation as well.
Can I ask a follow-up question, Chess? That's interesting. So just from that perspective then, if we're saying, I guess it's the point of the capital programme hasn't necessarily changed year on year, yet there's obviously the change of Newham applied and having had approved exceptional financial support. I guess I just wonder, is the rationale we have a similar scale of capital programme because we feel that the investment in the capital programme is necessary to relieve the revenue budget, in particular for TA pressures? There's that rationale where it's like, okay, we can accommodate this, even though it seems paradoxical to apply to additionally borrow when we're being given a capitalisation direction. Do you see me? So has the risk assessment been said where it's been like, it makes sense for us to do this, even though it might seem not the smartest thing to do, considering we have already high levels of borrowing, limiting then the headroom that we might have, and then also EFS, because we need to relieve the revenue pressures, and obviously EFS relieves revenue pressures as well.
I'd absolutely would say that is part of all the considerations that go into forming not just the draft budget paper, but something that's considered when we put together the July financial review, so a summer suite of reports which report on the council's financial performance for the previous year, and then sets out the medium-term financial outlook for basically is the medium-term financial strategy. And yes, I think we received the EFS for the first time in 24-25, and it's at that point that the capital programme is looking to just be business critical, return on investment, and long-term self-financing regeneration. So I think it's all consistent with the arguments, and it is part of the consideration in putting together those budgets and MTFS medium-term financial strategy.
I'm going to come to Councillor McAlmont because I know that you have to leave the chamber briefly at 7:05.
Yes, and this is going about the capital programme. I know many mentions we made about it, but Andrew, how would council ensure that the reduced this financial year capital programme remains deliverable and aligned with our priorities, given our historic level of slippage? And I think it's mentioned there's a 40% reduction in the forecast. And so basically my rationale is seeking assurance that the programme, the reduction is realistic, achievable, based on robust governance. And when I say governance, you know where I'm going, rather than optimistic bias.
Thank you, Councillor. So it's not been received by Cabinet yet, but it was published earlier this week, was our third quarter budget monitoring and financial information. Is that any chance you could look at that? So that'll be received by Cabinet on the 20th of January. And in the budget monitoring, we've made a forecast of our levels of capital spend in the current year. And I will also take you back to the Q2 report, which was received by Cabinet in October. And that did outline how we have reprofiled quite a lot of the capital programme, including within the HRA, so that it's much more realistic in terms of those budgets. And obviously that reprofiling rolls into the budget that will be set for 26-27. Just speaking sort of from memory, I think the capital forecast is a bit over 400 million in terms of spend or delivery, if you want to put it like that, for 25-26. Broadly or roughly half of that is within the housing revenue account, so the HRA, where we're looking at, you know, I think a slight underspend is forecast against the budget there of about 15 million. So something like, and I apologise, and I would encourage you to look at the papers, something like 210 million against a HRA budget of 225, and a similar position. So we'll be closer to the budget. An underspend is forecast. I think it's not uncommon, but you've heard me say this before, Councillor, I appreciate that. It's not uncommon for councils to underspend on their capital programme, and there are various reasons for that. But I think, you know, we're confident we'll spend in or around the forecast there, and that is in line, if he gives you some assurance, it is in line with the delivery in the previous financial year, 24-25. So it's not a million miles away from that.
Okay, right. Thank you, Andrew. You've given me a lot of figure, but part of my question was, given the historic level of slippage, and you mentioned that for the, you know, it's common for slippage to take place. What we want is, when you put the program before, you would have taken into account and you would have said that it's realistic. Now you've revised it, and assured are you that this revision is realistic and deliverable? I'm looking for a foul of slippage again.
Well, forgive me, Councillor, I mean, I can't take personal responsibility for the delivery of the projects. I'm not the budget holder for any of them. In terms of our forecasting, I think that's improving, and the forecasting is informing the budgets that we're proposing for next year. Indeed, we've already revised the budgets in line with that. So there is a sort of feedback loop from the forecast to changing the budgets, and I do think that's an improving picture. I mean, I'm not sure I'm able to sort of give you a cast iron guarantee if that's what you're sort of after on this, but you know, I think steps are being taken. It's recognised, thanks to the efforts, particularly of this committee. It's a recognised issue.
Never assurance.
Yeah.
For now.
Okay, I'm reasonably assured if I may, I'm reasonably assured we are improving in that matter. And I thank you for raising the issue.
Okay. I'm going to move to Councillor Adoy and then on to Councillor Onova.
I want to ask a question on page 12 and page 13 about our creditworthiness policy. So we lend from high quality financial institutions to manage our risk. But it talks about our operational limits are going to be reviewed and changed by the Section 151 officer. I want to know what the changes might be and how this might affect how we manage this.
Yeah, okay. So, Councillor, could you just repeat the question for me?
So currently we have high quality UK financial institutions, local authorities, people that we lend from, and we have certain limits in place, which ensures that we're managing our risk really well. However, on page 13, the second paragraph, after the bullet points, it says operational limits will be applied within the limits under specified and non-specified investments. The Section 151 officer will, on advice, make operational changes to these limits. So why these changes?
So why is that in the report? Absolutely. Thank you, Councillor. I understand.
Yeah, but I want to understand how that's going to affect our risk by changing these limits.
It's in the report really to make it clear that the 151 officer has powers to make some changes to what's set out here, not as a matter of routine, and perhaps we should be clearer. Not as a matter of routine. It would be in response to a sort of critical economic event or perhaps some sort of crisis which made certain classes of investments, a really bad idea. And despite what it says at the time of writing the report, something changes. Obviously, things do change in the economic landscape, and we need to retain that appropriate senior level to make some adjustments. So that's really, perhaps we could better describe that in the report for future editions. Thank you, but that's what it's there for. It's not sort of giving carte blanche for us to just change this without good cause and good reason. Obviously, a 151 officer wouldn't wouldn't do so without sort of taking advice and including the advice. And of course, they work very closely with our monitoring officer as well.
That's just the power they have, and they don't necessarily use it.
Indeed, yeah. But we can, that's really helpful. We can explain.
I was going to say, if I may add, as an example, sorry, Mania Hall, head for finance for financial controls and pensions. As example in the past, it's usually to say we are not investing to those institutions or certain authorities where the credit rating drops down, or where there've been significant risks identified with certain authorities.
Which might include reputational risks as well.
Yeah.
So.
Second question.
Yes.
Okay, on page 34, it's about subordinated loan development. And that's a high risk loan. It's a risky loan with a high interest rate. So from March to December last year, the accrued interest has gone up by almost 2 million. Is there anything that we can do to maybe get a better type of loans that we're not paying so much interest?
Thank you for the question. So the types of loans that we're making there to Populo, who are a housing delivery partner wholly owned by the council. So it's about sort of the stages of the development, really. So earlier on in your development, there is more risk generally in building projects, I suppose, in general. You know, you need to dig in to actually know what's in there. You can do all the surveys you like, but you don't really know what's underfoot until you dig down into there. There are all kinds of inherent risks with construction. The industry itself, there's, you know, subcontracting after subcontracting after subcontracting. The fluctuations there can be building material costs as well. It's a sort of it's a riskier endeavour. The loans we have made to Populo are done, you know, not on a preferential basis. It's at rates which are sort of market rates. They have to be by law. So you know, that's, you know, we're following what would happen in terms of a large institutional investor taking on or backing an investment project somewhere on a piece of land somewhere. So it mirrors that kind of process, really. So your investment phase, I think, is, I'm guessing this one, Manny. So you've got different phases of the projects as the projects become more secure. So the building's up, signed off by building regs. You can basically agree a lower rate in terms of the loans you are making against that asset. So you can refinance, you know, probably can refinance that with us, just as a large investor would with a development company in the private sector. You know, and it basically follows that. So the changes you see there essentially are driven by the changes with the developments that are being created. I'm really sorry, I probably wouldn't be able to sort of tell you the exact detail of the scheme and how them followed there in this meeting. But
it's not a question, more like, I guess, adding to Andrew's.
Oh.
Is that allowed, Chair? Sorry, it was just.
We come to Councillor Novo first, and then we'll
Yeah, of course.
check back.
Go ahead. I can.
Happy?
Sorry, it was just to add. I was sort of like adding greater clarity to Andrew's point that, like, councils, you can have assurance because councils are forced to lend on commercial terms to their wholly owned companies because of some subsidy control legislation. So that's what he means when he's talking about, like, they have to lend at the same rate that a private company would, and therefore can't be seen to be giving preferential terms to Populo. So it's not necessarily like decisions by the council, but governed. It's to maintain the, like, economic health of an area.
okay.
Thank you for that clarification. Before we move to Councillor Novo, does that answer your question, Councillor? Perfect.
Sorry, Chair.
No, I'm sorry. Councillor Novo.
Thank you, Chair. I think if I just start to explain before I actually pose my question, I just from the budget papers and from this TMSS, I'm seeing how you're trying to manage our capital position. I'm not really seeing how the plan to reduce it is not detailed there. I'd like it to be explained. I think going to Councillor Chowdhury's point earlier on the reserves, if we could go to 4.34 4.3.4, sorry. It says, while the bank rate remains elevated, borrowing from internal cash reserves is likely to be fully utilised. As a result, future growth and capital financing requirement will need to be funded from external borrowing. In addition, the council's cash reserves may come under pressure to support the budget strategy, requiring further external borrowing to replace internal borrowing. I just would like to have some assurance over. I want to see how the strategy is supposed to work to not just manage our borrowing position, but also to reduce it. I want to see what you're doing in terms of increasing our reserves and what risk is associated with how overextended we are in using our cash reserves. I also want to understand on the surface, it would look at like a prudent strategy to use your internal cash reserves before extending to external borrowing, right? But at that point that they, run out, then there's no headroom whatsoever. And so that means what you'd have to pull from revenue that should be going on public services to finance our borrowing. So I just, if you could explain that to me, that'd be really helpful. And if you don't mind, depending on the answer, I might have a supplementary.
Yes.
Yeah, really, thank you. Really, really good questions. I'll attempt the explanation. There may need to be some back and forth on this, I think, but we'll try. So in terms of the council's reserves, they ran down completely, but they did reduce during the pandemic, and then they also heavily, they took a big reduction in 23-24, I think, the big overspend year. So we did see a significant reduction in reserves. The revenue budget we set every year includes an allowance to basically set money aside and add to our general reserve. It's just under 3 million, that budget, for the current financial year. It's been there for the last few years. And even though we've sort of managed to take from other reserves, we've with that and increased the reserve. We have, I have a new line manager, a new Section 151 officer, and she absolutely doing a review of our reserves as well, just making sure they are basically in the right place and held for the right purpose. So that's something to sort of just a training, if you like, that's coming ahead. Of course, that won't sort of generate any new cash. The review can't generate. But we are. I mean, the revenue budget proposed for next year again looks to increase the general reserve there. In terms of how that relates to cash, so well, the reserves are backed up by the statement of accounts. That's our position, but we simply don't hold in the council's bank accounts loads of cash to back those reserves. We will, and this is what's meant by internal borrowing. If we I suppose you could hold all the cash equal to the level to the reserves that you're holding on your balance sheet, but I mean, it wouldn't make very good financial sense because there's a cost of carry, cost of not using that money in some way. So we try and maintain a sort of £50 million float, if you like, from month to month, and any excess cash we'll use for internal purposes, like the capital programme, and that creates this sort of internal borrowing position. Or in a very short term, if we get sort of cash flow is quite bumpy, if we get excess cash balances, we'll lend it back to Treasury and then get it back, and that will generate some level of return for us. So we're not losing on that. So I mean, we certainly wouldn't ever be in a position where you see the reserves and we'd have the cash to back those reserves at all times. We've essentially under borrowed, but that is why this report, the prudential indicators, your involvement here is so important, really, because it sets out the CFR, the capital financing requirement, the CFR, which sort of really demonstrates the true levels of borrowing need for the authority. And it's really important that we report on that and that you know and that you see that. So hopefully you're able to see what it is. Your colleague spoke about the borough having one of the highest levels of debt in London. That's certainly true. And I want to be clear with you, though, that that's in terms of sort of pounds and pence, that's not going to go down anytime soon. There are the capital programme in train and things that wouldn't really make sense to stop doing because you might end up with lots of what are known as abortive costs on those that you'd have to recognise in year as well. And you know, as I sort of said, the majority of the capital programme is intended to be self-financing and generate a return over the long term. But the borrowing will go up. So when we borrow for new capital projects, we'll manage our cash position. We'll only do it when we really have to, and that's to control our costs on borrowing. Sorry, but if you take out £50 million of borrowing halfway through the year, I'd say, oh dear, I think my maths is going to come under scrutiny, isn't it? I'd say sort of 5%, that would be £2.5 million per year, but you'd only incur half of that for half the year. The following year, you're going to get the whole £2.5 million. So our borrowing costs, you know, they will increase, and the revenue budget does recognise that. I would, sorry, I think I'm really trying here. So the table 8 of the Prudential, it sort of shows a projection of our borrowing costs, and also looks backwards slightly as well. And I think that's something to keep an eye on as well, because it gives a percentage of our revenue budget that goes towards borrowing costs, and it's edging towards 20%, I believe. So I'm sort of speaking from memory. That future years goes out just over 20%. As we look to review, delete schemes, complete delete schemes, we are. I think you'll see that sort of percentage in the next edition of this come down a bit marginally. So you will start to see some impact of the review of the capital, and making sure that we are only investing where we really have to now. And also one other thing I think will move that number is actually our net revenue budget, the denominator in that sum, that's going up, and that will actually go up quite heavily over the next 3 years due to the fairer funding. So as a percentage, I think it will flatline really, rather than so of the money that we have available to spend. Well, it doesn't go up steeply in the papers here, but we'll expect those numbers will change in the next edition of this report, and you won't sort of see an acceleration in the percentage there. But yeah, I mean, our debt will continue to rise in the medium term, certainly. So I want to be clear on that point. It's whether that is manageable and felt manageable by the council. It's at sort of 20%, I think, will be held more or less there. Of course, you know, what will the future hold? The capital programme does contain, you know, the pipeline for the capital programme contains many large regeneration schemes. Different decisions can be made in future on those, and you know, that will dictate how big those numbers and those indicators are in the future. But once borrowing is taken, we do pay it down, and we pay it down using a mechanism called the minimum revenue provision. So every year the revenue budget does, of course, set aside money to effectively pay down that debt as well. It doesn't actually repay it, but it is a handbrake on the council's budget, and it does pay it down. That got a bit technical, and I probably explained it inadequately. So I don't know.
No, sorry, I do just
happy to go into it again.
Some supplementaries, if that's it. To our reserves.
Yep.
I want to know, after the contributions set out in the draft budget proposals, what percentage for revenue will be at in the reserves, and what percentage do we intend to get to in the medium term financial strategy? Then appended to that, understanding given the fact that you've said that our borrowing will not go down anytime soon, and the fact that we have high borrowing, whether it would be smart to go beyond the kind of minimum 5% that would be recommended for councils in their cash reserves, and whether that's something that's feasible. Then secondly, you said obviously very, very clear on abortive costs with the capital programme, etc. But I'm also just querying kind of the modelling around kind of future returns that we could get from some bits of our capital programme, like in the HRA budget and, the regeneration schemes, etc. How has that been costed by you in an event where, we might underperform in our returns from those capital projects? How would we be able to manage? And then, also in that, we also, in the TMSS, it's kind of clear, it's very prudent. We kind of short-term investments, low yield, etc. But then again, the headroom issue, and that we just don't have other means of generating cash to be able to service our debt. I think that, gives me it makes me a little bit uncomfortable. I'd like to have assurance on that. And then, sorry.
Just repeat that point for me.
It was just, you mentioned it earlier when you were doing your introduction as well, just on the fact that we are kind of not taking any kind of high risk investments and, short-term kind of low risk, but also what you didn't say is that those are obviously then low yield, right? And given, the financial position that I don't need to set out again, that doesn't give us much. So I'd like to have an explanation on that. And then, you also spoke about fair funding contributing to a trending kind of decrease in the percentage of the general fund used to finance our costs. I also saw in the TMSS a quite detailed bit on interest rates, and I want to know exactly how much you've hedged interest rates into your assumptions of how much our debt will be year to year in the MTFS. And, just to understand that, because I just, you've come to the assumption that interest rates will trend downwards over a period of time, and then caveated that by saying, but kind of ceteris paribus, but dependent on international crises or events that may change. But I just want to know how much you then built that caveat into your assumptions that meant that you've had interest rates trending downwards over a period of time. Sorry, I know that's a lot.
No, thank you. Is that clear for you, Andrew?
Yeah, very last one, I do have colleagues online as well. So colleagues, if you could just double check our assumption on interest rates, please. And we'll get back to that once you've done that. You talked about reserves, and there is a sort of benchmark 5% recommended level as appropriate for most councils. And we are we are from the general reserve. There are, of course, other reserves. You mentioned the Treasury Reserve. There is, each year we do, as part of our going concern statement, an analysis and breakdown of all the reserves. Happy to send that around as well. And that does come to Audit Committee as well. And just sort of outlines what the reserves are held for and discusses the issues of the 5%. But we're not at 5%, and we won't be just on the basis of this 4 million. It needs to be a continued strategy of building that up. And that is something that we've talked about in our section 25 statement of the budget set. really important part of that. And which considers the adequacy of our reserves. But of course, it doesn't just take a single year view, it does take a medium-term position. And it is the medium-term position that we're planning to increase them year on year. Councillor, you talked sort of about abortive costs, and perhaps I gave you, I suppose, a slightly one-sided view on that. There are abortive costs if you decide to pull and end a capital project, but it is a decision that councils can and do take. A lot of the large self-financing element of the capital programme, it's a policy decision. It's policy proposals. Yes, there's risks and there's financial implications. I won't talk about any specifics, but where you've created assets, they are worth something and can be sold. There may be abortive costs on some schemes, but these things would equally have to be taken into consideration should different policy decisions be made. So I hope that answers that one. You talked about the HRA. So where we are borrowing for HRA purposes, and actually the HRA does benefit from a slightly lower rate of interest from when we borrow from the Public Works Loan Board, the PWLB, and that is obviously a sort of central government policy to encourage housing development, but also investment in the current housing stock. So those things are outlined in the HRA business plan document that went to Cabinet back in December 5. I'm sorry, I can't sort of quote numbers at you. It's probably not very helpful that I do so anyway, but that sets out over the long term the sustainability of the HRA. It's very heavily ring fenced from the rest of the council's operations. The rent that's driven, or rent that arises from nearly 17,000 homes for residents in this borough, that is all goes back into operating services for the HRA, but also covering the cost of borrowing for the HRA to maintain and improve homes and create some new homes as well. And it's, we model that over the long term, just as other councils will do as well. So it's worth looking at that.
Just my question was, in the event that we don't see the returns, so at some where this regeneration program, building these homes, which yes can be sold, but really they're supposed to be at whether it's market or affordable rent, that's supposed to then add to that revenue account, right? And so the risk there is that if we do not get the returns on that investment, how does that affect our position?
Okay. The HRA business plan is a iterative thing. So as things change, it will be adjusted. So should something go quite wrong with perhaps a scheme in the HRA, we'd have to adjust the business plan to say, well, we were expecting rents for these flats for the next 25, 30, 40 years. It's no longer going to be the case. We'd have to make changes to the business plan on that. But it's a regular thing. In terms of managing risks, though, especially with capital, the business cases and the reports that come to Cabinet to approve any individual capital scheme. So all those schemes in and of themselves, unless it's £50,000 or something, obviously there's appropriate levels, but by and large, most capital schemes will come to Cabinet and the financial implications will be set out there for each.
It's above 500 grand.
Yeah. I mean, most they will come to Cabinet. There are contingency budgets, risk allowances. The council does, this is not a valid organisation. There is a level of prudence and sort of healthy scepticism, I suppose, built into our modelling, and they're long-term models. So if you build a scheme, we're looking at how long will it take to build in year 1 or 2, but certainly what are the likely income streams from that? Do we make an allowance for voids? So if we've got a new block, we know that from time to time some of those units will be empty, and that has a financial cost. So there is voids, there is bad debt, all these things that from experience we've seen in the HRA, and indeed any other capital scheme. those are well accounted for really in the financial implications for those schemes. So I suppose you should take assurance about from the process, and also, of course, we encourage everyone to scrutinise the reports and raise questions as you are doing. Interest rate risk.
So just before we go there, can I say one thing? The only reason I don't have assurance there with the process is because last audit committee, we had an improvement board report come to us that referred to the council as a bit fatalistic. So just, you know, we can't do this. We don't see a way out of this. That is not favourable in the kind of financial situation that we find ourselves in. And so just having some assurance over consideration of options and how you have, you know, how you've come to build, you know, a healthy level of skepticism into your modelling, I feel was necessary. But I really appreciate the level of depth that you've gone into today.
Do you want me to comment on
just comment.
I mean, the council is not just finance, it's a team endeavour. Perhaps professionally, you generally tend to find more prudence and scepticism in the financial profession, but we're not, you know, we are working as a team with others. So there's, I think, got to be a healthy balance of all those factors that you've mentioned.
Thank you.
You have an answer on interest rates? You asked about the interest rate assumption in the projections going forward. I believe I think we only whilst we're looking, we have some external advisors who give some general advice on interest rates, and the general impressions that they are coming down. We've set the TMSS on. We've prepared the TMSS on current rates, haven't we? Can we just check that point?
Oh yeah, I will ask the question.
Chair, can I come back to you on that?
Yeah, let's move on and come back to that. I'm going to move to Councillor Paul now, and then I'll move to Councillor Edward.
Thank you.
Yeah.
I want to build on the excellent questions of my colleagues, Andrew. And the preface to my question, he said this is going to be the last report going to Cabinet before the new administration starts in May, before the election. And obviously, it sets, perhaps could be used as a baseline, the new council to review what's gone on. So that's the pretext.
Okay.
Questions. Got an Alexa raised point. One of the highest leverage boroughs in London, one of the few boroughs which had less. Okay, so there is a link. Let's say high borrowing, and we have to go cap in hand to government for support. And bear in mind that's the state of affairs. I wondered whether the report to Cabinet can be slightly more pointing in that direction. A point made by Alexa as well. The report doesn't even reference EFS at all. Doesn't mention the amounts of, it doesn't be mentioned 24-25 and the large, I think it was £67 million hole in our revenue account, and the sort of process from there to where we are now. There's no narrative on how we got here. Okay, it's as if you read the report, you know we had financial straits over the past 2 years. So really what I'm asking for, perhaps, and through you, Chair, is that officers go away and reconsider the report and perhaps set the record straight. Because the report doesn't reflect the actuality of our financial position in its strategic context. And I'll just go through some points, and perhaps Andrew, you can come back to me in some reflections on what I've just said. So Councillor Nova made the point about reserves, and so did Alexis. But there's no link. There's a linkage between high borrowing and using our, revenue to pay the interest. There's a linkage. There's a linkage on the impact of services. And in the report, there's no narrative statement on the impact of high borrowing and the opportunity cost on that for paying for services. Mentioned the point that the reserves are below 5%. I would have thought, bearing in mind the large settlement we got from the government, number one on our priority would be to put a little bit more than £3 million in our reserves before we seek to spend other new projects. And having a statement in the report provides the assurance, but we're acting with probity. And at the moment, there's no narrative discussion. One of the first things perhaps you could do is what amount of money would it need for us to go to 5%? If we're not going to use that money, why not? And that needs to be justified, I feel, it may be in this report here, but maybe in a future report that's on reserves. In terms of our time frame of the report, yes, this report complies with the SIPA regulations and the annual investment strategy, but at the same time, the interim section 151 is hoping to go to a 5-year MTFS in the near term. And it would be useful that we get synergy between the treasury management strategy and the MTFS. And there isn't a linkage between the two or a note in the report of where the drop-offs are. So if we have to comply with SIPA, this is a SIPA report bit, it's year 1, However, bearing in mind we've got MTFS of 3, perhaps going to 5 years, this is the addendum to the report, which you might find helpful public. And one final point, Chair, and I'll be quiet. I think the report needs to make reference to EFS, the narrative, the story on that. You say our borrowing highest in London, no comparative data in the report which sets that out, and as to why, and what is a good level of borrowing. And the reason why I give those comments is this report should be a sort of wash up of this administration as we go to the next administration. And through you, Chair, and perhaps I've given a lot there, but my excellent colleagues had asked the detailed questions, and my questions are really a reflection on their questions and the answers you gave, Andrew. Thank you, Chair.
Thank you, Councillor. It's okay if I respond, Chair. So, some really good points for reflection there. I'm not pushing back on this or anything, but I mean, we have brought this, as you say, in line with sort of SIPA guidance of bring, full scrutiny to audit committee. I guess my immediate reflection is it's a bit narrow, isn't it? Because this is essentially one component of the budget report that we'll be bringing in February. And I absolutely think we could add to it and create some more links to some of the other points in that budget report. And I think you're making some very fair comments on what the narrative may contain in that budget report as well. So that's pretty helpful. You also sort of, what I wrote down as you were talking, Councillor, was what the borrowing is for, ? So yes, we've £1.4 million of borrowing. So perhaps we can add some analysis of some of that is really historic, and there are limits to what we can glean from the information we've got. But we do know where the money's gone, all the assets created. So we could provide some of that information in the future.
For narrative explanation, Alexa's great point. You wouldn't know we've got EFS if you didn't know. Bearing in mind number one. Number two, we've got a large dollop of money from the government. There's no reference in here. And there's no reference. We keep seeing other reports, one of the poorest boroughs in London, yada, yada, yada. But we're paying large amounts of money for interest. In terms of our borrowing, I feel that it's prudent to state that if you're a Martian, you need to.
Thank you. Just one, I'm not looking to have the final word or anything, Councillor, but we could do that. And, if we set that out, what you'd see is that much of the borrowing has gone for the purposes of, like I said earlier, trying to reduce our revenue costs or to income generating assets as well, which, I would completely take the point. You wouldn't get that or glean that from the report. Thank you, Andrew.
I'll build on that for a moment, if I may. I think Councillor Paul makes a very valid point, and I'd be keen to understand what assurances you could make that ahead of the cabinet meeting where you're going to submit this draft report, what additional flavour or context based on the members' points this evening can be added ahead of that. Are you able to comment on that and provide us assurances for that now, or is that something you'd want to write to us after about?
Well, I mean, the purpose of coming here tonight is to hear what you have to say, and it's not at all our intent to not act upon it. So that's a very quick level of assurance. I I suppose I could just say, well, wait and see the final edition, and you'll see the changes on board. But I will attempt to find time to sort of point them out. Perhaps future. Perhaps what I'm saying is we could communicate to you some of the points we've addressed from this meeting.
That'd be helpful. Yeah, we can follow up on that.
Just to build on your comment there, and you gave half the answer. There is an opportunity in the forthcoming budget. There's lots of narrative. Sometimes it's not valuable, but some of the comments raised here tonight, yes, I think there'd be some additional comments raised on the Treasury Management Board, but also I think some of the comments and the flames from tonight could and should be reflected in the final budget papers going forward to full council in February. So I think, in a sense, it's a two-part answer. Yes, in the immediacy, cabinet report on the treasury management, but I think the committee will be looking forward to whatever papers you put forward to budget in February, but the adequate narrative and the comments from this committee is considered.
I mean, I won't attempt to write the report in my head or anything, or workshop it in this, but kind of sure, we'll take all these comments into consideration. We do value it and we do hear it.
Thank you, Chair.
We'll move to Councillor Adori and then Joanne, but I just want to note that we had originally set 60 minutes, but as we only have one substantive agenda item this evening, I think we'll continue this line of questioning. So, Councillor Adori.
Just on 4.3 then, just for us to clearly understand, where it says that because of the public strategy, the council's cash reserves may come under pressure and then the external borrowing replacing the internal. Can you just explain at this current moment, would you say that the cash reserves are under pressure? And in your professional opinion, what do you envisage happening next year? Do you envisage us really dipping into those reserves, even though they might be talking?
So we have only borrowed, I appreciate that. It's still a large sum of money. We do manage our cash position really tightly. And I know, and I'm grateful to my Treasury colleagues for doing so, that we'll look to take advantage of any balances in excess of what we need to hold in the float I talked about earlier. So we have only gone out to borrow from PWLB £40 million so far this year. I mean, the capital programme is spending, I guess sort of 400 million in total. Obviously, some of that is funded by grants, for example. So we're managing the cash position really pretty successfully, I think. We've not had to do it ebbs and flows, I suppose, but certainly over Christmas, for example, we were taking advantage and loaning excess balances out, and it's all felt quite manageable. So my professional opinion is we don't have a sort of cash crunch at the moment.
I just have one last question.
Yes.
Page 10, 4.46, it talks about, they're really saying that it's lots of short-term borrowing, no long-term, just short-term. And then 4.46 talks about major regeneration schemes and that you're making decisions as and when things happen. What is the risk that we just, as and when things happen, when there's a major regeneration scheme and then we have to we can't borrow or something like that? What's the risk of something going wrong with our regeneration schemes?
What's the risk of something going on? Not being able to access
funding,
borrowing when we need to,
because everything is so short term, and we're not planning in advance. What's the risk of things going wrong with the regeneration scheme?
We're borrowing short term at the moment because the shorter term interest rates with PWLB are less than the longer term, so we would just then switch to the longer term rates once they start coming down.
And I'll add, we do take independent expert advice on this as well, and from an outfit with the sort of MUFG, professional advisors in this space. They advise a number of councils, and they will what they do is also give us advice on the term that we borrow money for. So they'll obviously seek to avoid a concentration. So if we take out sort of 10 million here, 20 million there, 30 million, and they somehow all need refinancing in the same short-term window in 5 years or 10 years or 15 years time, that's something to be avoided. So we take their advice, and it's very helpful And obviously we do that work ourselves to spread the maturity, thank you, the maturity dates of the loans that we take to manage that risk. I mean, but you're quite right to sort of point out risks are inherent in this sector.
And if just to add, we borrow from PWLB rather than any of the market, so it's unlikely we wouldn't be able to borrow.
Move to Joanne Pitt and then Councillor Onova.
In looking at 4.1.3, the investments to subsidiary companies, can you provide assurance of their sort of monitoring and reporting back so that you know that those loans are, you know, you're not at risk at having those loans fall at the council's feet?
Sorry, could you just repeat the last?
So if it's just so that you can provide assurance that you're monitoring how those companies are paying back those loans to ensure that those loans are being paid back and that the risk doesn't return to the council.
Say, well, while the development's happening, we're not expecting any payments back from loans while they're constructing the assets. But once they have been completed and become operational, then the loan switches into sort of repayment and interest. So we do monitor and look at those loans and ensure.
So our sort of expectations for the year, when we set our sort of borrowing and investment budgets, we've got sort of a breakdown of what we're expecting to get back from Populo, principally. So we'll monitor that through the monitoring, and all of that sort of aggregates to the 2.9 million overspend that we got questioned on earlier. So there's a lot more detail underneath that figure, which breaks down, what we're expecting to borrow. The forecasting for this is in terms of what we're going to spend and borrow, there's a lot of uncertainty, especially at the start of the year on it, as you might expect. But with operational schemes on Populo, it's operating to plan, if you like. So where the schemes are returning them, it's back through there, and we monitor them.
Thank you.
Yeah, I hope that. I mean, and ultimately, we do own Populo. They produce their statutory accounts, are audited independently to our auditors, and they form a part of our group accounts. So, those auditors are looking to make sure they're paying back the money in their accounts are in good order, just as our auditors will be checking. So that level provides an additional level of assurance.
Thank you. Councillor Onova.
Go.
Sorry. No. Just a follow-up on John's question, but you go.
I don't have.
Just on Joanne's question about loans and performance of loans. Lots of our loans, roughly 300 from memory, about 300 borrowing capacity, about 325, of which 40 have been discharged. Lots of that is for Populo and on homes. Right. Those homes are effectively a sunk cost. It's done, dusted. It go back to it. So what are we doing about reducing our appetite for these loans? And when we say performance of these loans, a lot of these homes we're borrowing at market rate, but lending them out at affordable. So we are subsidising. We're not getting back, right? So that's the thing. We're not getting back. Oh, we're borrowing at market, but the rents are suboptimal in terms of social rents or intermediate. Am I correct?
No, I don't sort of recognise everything you've said there.
Okay.
But so we're not sort of allowed to offer an economic advantage to that company, which is what our colleague was sort of outlining there. So we can't, although we can borrow quite cheaply from PWLB, just as all councils do, and it's a relatively cheap source of funding. We can't just automatically pass that benefit on to a wholly owned company. It'd be distorting.
And just to the other side, and that's fine.
Yeah.
He's correcting my lack of knowledge there on that one. But surely lots of our loans are due to because in the current corporate plan we had to go and build loads of homes, right? But going forward, if that isn't it, and our borrowing profile, appetite and risk changes?
Yes, I mean, yes.
Right. Back to my earlier point, and Joanne's point triggered a memory. I think it's really important in treasury management, we allude to potential change of strategy. And what that does, if we're not building loads of homes, that does affect our borrowing profile.
It would affect your future
Exactly.
borrowing profile. I mean, as I spoke earlier, we have the debt that we have, and some increases are sort of baked in, if you like.
Yeah.
But I mean, that is the result of the policy direction and decisions made by this council.
And just to make a small point, Chair, and I'll be brief, and it's a really great question you prompted me. I do think that a potential change of narrative needs to be documented in future. Because when I looked at your charts, I looked at the loans, you look at it a different lens if you know that the ambition of an organisation is going to change, right? It's going to change because it's up to the new mayor, right? If they decide to concrete over Newham again, then we're going to have to borrow even more money on what we've got, right? But obviously there's a capacity for what our balance sheet can take. And again, I see in the report no measure of prudence of how much can the balance sheet of Newham take. And in fact, to Councillor Adodo's point about what happens if things go wrong in the future.
Yeah.
No one predicted Ukraine, energy spikes, the financial crash, that sort of thing. So really what I'm saying, and perhaps I'm egging my own point, but you can see why I have a slight intellectual curiosity to make sure. But our documentation going forward really bolts in our treasury management strategy into the corporate ambitions of the organisation. So you can clearly see a read through in terms of the policy of the organisation, the borrowing policy of the organisation, and the impact on services. Being highly leveraged as an organisation means more money for interest and less money for services. Well, thank you, Joe, for the point, because that really prompted me.
Thanks. I'd like to respond, but before I do, just to come back on an earlier question, actually. So in the TMSS, we prepared our sort of projections into future years on the basis of the borrowing rates that we are experiencing or were experiencing in early December. So although our advisors and the general market outlook is that interest rates will come down from that point, and they may not be right, they have been wrong before, for prudence and perhaps, well, we had a discussion effectively about risk appetite and attitude, didn't we? But I feel happy and content that for prudence, we've used those sort of current higher rates of interest in the projection. So I just wanted to round that question off. And then coming back to Councillor Paul, I mean, you talked about sort of basically about the housing development schemes there as well. Yes, I agree with you then, we may get policy changes in the future. That's absolutely true. In terms of what has been created in the schemes that exist, as I said, there's cabinet level reports with very detailed financial models and a whole process that goes into approving any of those schemes. There is allowance made for things like voids and bad debts. Sorry, I'm repeating myself a little, but when those schemes are devised, the levels of rent to income are part of that modelling. So you sort of talked about there's market rent that can be achieved. There's London affordable rent, there's sort of shared ownership type rents as well. All of that I just wanted to give you assurance that is taken into account in the models for each scheme.
But have we modelled the change in leasehold to common hold? Right, we haven't modelled that, have we?
I'm not able to comment on that.
Exactly. So
I don't.
Right. So we've made an assumptions on houses which are built with leasehold, right? The government's changing the rules on leasehold, which will impact the MPV and the profitability of those schemes if we were to do today. I suspect you've not modelled in all our developments the impact of leasehold changes and the impact of cash flow.
Sorry, I don't feel able to to answer that question. We could look
White paper's not even out yet, so.
Yeah, it's not even out, but it's just, yeah, I think we agree.
Yeah.
It's not necessarily a question, but I suppose a point of like clarity on something you said, Councillor Paul, about the council lending to Populo and the business model being dependent on affordable rent, and therefore that somehow giving the council a disadvantage in its wholly owned company. That's not actually how it works. It's the council will the council will borrow at PWRB rates. The council will then on lend to Populo and has to lend to Populo on commercial terms because of rules dictated by the Subsidy Control Act. What then would be conferred within, so the council can't be seen, cannot legally give a preferential term to its wholly owned company within the on lending. The separate point is about the business plan underpinning Populo. I'm also, you'll know much better than me, but I don't know what the tenant occupancy, like the profile of tenant occupants in Populo is, whether they're at market rent, LHO, whatever. Whatever would be within the business plan of Populo would be, that would then dictate the affordability of that, then the ability for, however the loan is structured, for the council to either repay that loan if that is part of the plan, or have however it's recognised in Populo's accounts. There are benefits to having a wholly owned company because of what, for example, if it is at wholly owned LHA, there are freedoms that are allowed to a company over a council in terms of the amount that can be reclaimed from central government from having LHA tenants. So there may, in terms of, it's not necessarily a foregone conclusion that it would be disadvantageous for the council to be having a wholly owned company yet. Anyway, that was the point.
Do you have a reply?
That's fine.
We're going to move to Councillor Onovo and then Councillor McCalmont.
When I initially wanted to ask a question, it was on this same vein, but a lot of it has already been unpicked. But I just, again, to avoid confusion, I just want to understand how it would work, given that a lot of our debt is in, regeneration, house building, etc. Just understand how that looks like. Like, example, like say, like carpenters, say for whatever reason, massive delay, or, just some sort of shock to the market, etc. that happens. And we don't yet get to move people in, they don't yet get to start paying rent, etc. But we've still got to service our debt. What does it look like when the council manages that scenario? So we expected people to move in 2030, but actually nobody can move in until 2035. How do we then service our debt?
So you're sort of describing a really, if I may, like quite an extreme.
It's just okay. Give me a more reasonable example, and then tell me how we would manage that.
I'm not sure I'm able to give you like the fullest of answers. I would probably, invite that, if they were here, invite housing development colleagues to really sort of talk to you. Council works very hard to mitigate and manage risks. I can't really, I don't want to say that. I mean, you're effectively sort of talking about 100% void for 5 years, which would clearly be a huge financial impact on a scheme or on a project. Action would be taken of some sort in that, you do something. If you had a huge, you could have some sort of leak or flood, I suppose, in a block that
it's not really because, sorry, just to give context, because for instance, we've already, as happens with a lot of housing developments, it's why a lot of people are kind of more averse to building, etc., planning applications, building safety regulator, blah, blah, blah. But you see that you might have put in a business case and submitted designs to the building safety regulator. They've sent it back. Now you've pushed back building by another 6 to 12 months because you have to wait for the surveyors to get in again. And then they might come in, they might find another issue. It then gets pushed again. So let's even say it's 18 months. And we've had a set date of being able to have people move in and pay rent that was supposed to, you know, show on our revenue accounts, and that's not happened, given that a lot of our debt is built on homes that just in the way the market works are subject to these kinds of shocks, right? How would we deal with that? And I know you're saying this is a question for housing, but I do think given that this is covered in the TMSS, like just in terms of how team finance and the council would handle this, I'd just like to understand.
So we do stress test the business cases and scenarios, perhaps not sort of to the absolute extreme degree. But there is some stress testing in that and contingencies built in. And you could, I mean, I'm really not very well qualified to talk about sort of operational things you might do, but you might sort of look at changing your tenure mix. We talked earlier about different kinds of rents that could be achieved. You can also sell units as well, of course, so to recover some of the money. But I mean, I think one of the biggest mitigations against the kind of risk you outlined is that we work very hard not to borrow in advance of need.
Okay.
Building contractors are tightly managed, and there will be staged payments. You know, builders don't receive all their money for creating an asset until typically 6 months or 12 months after the completion. There's a retention there. So you know, these are ways of helping to, you know, they've obviously got skin in the game, if you like, to make sure that the building is completed and signed off and becomes operational. But for our part in finance, there is modelling, the stress testing, and we don't borrow in advance of the time that we need to borrow. We work very hard not to sort of over borrow and then not spend the money because of the delays. We're not paying the developers if things don't get created. There are staged milestones on capital projects, so that these risks exist, of course, but these are ways of mitigating those risks.
Sure.
I'm going to move to Councillor McAlmont and then Councillor Alam, and then I'll move to Councillor Odoy.
Thanks, Chair. Just from memory, Andrew, and we talked about the pop rule funding and loans, etc. So I got that conversation. If I remember correctly, our funding arrangements for pop use changed, and I think it was 2 years or so ago, where we do not loan them anymore. They basically provide a service for us, and we pay them a fee. Is that it? When you they scored something million or something, but we used to loan them money, and then they pay back with an interest, what Alexa was alluding to. But that arrangement has changed now, as it is.
Yes, you're correct, Councillor. So they are a sort of delivery partner. So their expertise is used to sort of manage a lot of the things I just described, really, the functioning of contractors, builders, monitoring the stage payments and that sort of thing. But we aren't, so the relationship has changed. So we aren't loaning Popular as an entity these sort of investment and development loans that we spoke about earlier, using them as another contractor, if you like,
correct,
to help create these assets.
So therefore, it's the money stays with us. We just pay them for delivering the service.
Yeah, we're paying for services, essentially goods that create assets.
Thanks. I just wanted to.
It's a fairly significant change in the sort of Popular business plan and operational model.
Okay, thank you.
Thank you. Councillor Alam.
Sorry, I was just going to rephrase Councillor Honorable's questions. The question, I think, still remains pretty much unanswered. Was there any precedent taken this kind of scenario where the block of flats been built, but no one to move in, or it has not been done in time, whether the cost is going up?
I'm offhand, I can't think of a. Maybe I cannot recall or think of an example of that scenario happening with our popular developments. Of course, there have been risks, and some of those are materialized in certain developments where you would get certain things cost more money than perhaps you planned, and delays are often experienced in endeavors of this nature in the housing development game. But I'm sorry, I haven't got a example.
Sorry, my question, I mean, I was just going to rephrase our question, but my question is there any kind of measures are in place to ensure this kind of, I'm sure we haven't had that kind of event, but if there is one, is there any kind of measures are there to
things that the council has in place to prevent it from happening?
Yeah.
Is that what you mean? Yes, I'm sure there are. I would sort of encourage the committee to write to housing colleagues for more detail on that. I'm just not qualified or in a position to really answer that question.
I'd add a follow on to that. Is there any scenario outside of the housing committee where there is a risk, an investment, the return on an investment would be delayed, and what kind of measures are in place to mitigate that? Because it noted that we'll write to the housing committee about that, but I'm curious to understand anything beyond their remit.
Sorry, Chair, I'm not meaning to be unhelpful, but if you could just ask that question again whilst I think about it.
Do you want to come in at all?
Yeah.
Yeah, sorry.
I think the issue, one, it'd be an issue for, let's say, housing scrutiny, but I think the issue is about the model, right? So when we say we're going to do scheme A, we make a set of assumptions to build a model which it knows how we're going to fund it. It's back to the other thing. There are things there are known unknowns, i.e., for example, forthcoming changes in the rents in leasehold common hold. There might be change which we haven't modelled, which might have an impact. The way we mitigate that is to ask the question: has housing got a paper which looks at the impact assessment of that, for example, right? Because that is one thing which is an unknown, it's a known unknown, which could affect the very model which drives the viability of that scheme. So the answer, Andrew, will be perhaps you go back to housing colleagues and ask them to assess the assumptions used in developing their models. And for example, renters' rights bill coming forward, the changes in leasehold to common hold. The question is, what is the impact on the existing models of our schemes? That would be a way, I think, because we don't measure unknown risk. We could find those schemes being unviable because of legislative changes. That's the
I wonder if I could, Councillor Paul, is that the term or the phrase that sprung to my mind as you were speaking then was, it felt like sort of like a horizon scanning that was needed. What is out there that may impact on these models and
it's a scenario planning, right? So at the moment, housing in the past have made an assumption based on a set of conditions, right? If those conditions change, like interest rates, Ukraine war, asteroid lands, the Bank of England gets blown up, then things change, right?
Certainly the interest rate risk, which I suppose is inherently linked to some of the other, global economic type risks that exist. Those are part of the stress testing models, which are produced for each scheme. And then, they are reviewed by another set of accountants.
Do we look at legislative risk? That's the issue. Do we look at legislative risk? Do we monitor changes in the law? That's the thing. Well, you could ask your housing colleagues to do that. By you, Chair.
Okay, thank you. And before I go to Councillor Odoi, Councillor Nova, do you have a comment or a build on Councillor?
Let Councillor Odoi go. It can come later, but it is just a clarification.
Yeah, mine is also just a clarification.
Okay, well,
on Councillor Nova and Councillor Allen's point, I wanted to say that the Cutting House Regeneration, so I was in the steering group of 2019, and that's definitely delayed. And it wouldn't be fair for me to ask you, like, what's been the cost of that delay? Like, how has that affected us? It wouldn't be fair for me to expect you to know the figure. But maybe we should actually keep track of, like, generating schemes. How far have they delayed and what's been the impact?
The housing scrutiny, not for this committee.
Not for this committee, but like we're just asking that question about where delays have happened or where different things have happened that weren't the plan. What was the impact? We should know that somewhere. It should be somewhere.
I do sort of feel there's naturally an overlap, isn't there, between the subject for audit committee and also the relevant scrutiny committees, and you probably don't have the right people in the room to answer all of these questions. I'm sorry.
No, that's fine. I appreciate that. Councillor.
My comment was on a similar vein, but it's more to bring it back to what the point that I was trying to make is that, I was using kind of hypothetical examples, but I think as a council, we have enough precedent of these issues happening. And then every year we get, a treasury report or something else saying, X percentage or X amount of slippage, when it just should be built in the model that these things happen. That's the kind of point that I'm trying to make. It's not whether housing has done this or but housing has done this in the point. What Councillor Doyle was trying to say around Custom House or whatever delays happen with carpenters, etc. We've just seen this being, if it's a trend somewhere, it is for finance to build that in, to actively, because you do talk about the HRA and the TMSS, so it's not tangential to make the point that we don't have assurance that you have adequately built these risks into your model that mean that we don't see this kind of slippage year on year on year on. That's the point I was trying to make. But
I think it's not just a Newham issue. It's a national council issue in terms of capital monitoring, slippage, and programmes. I know from experience, you will get a project manager going, yeah, I'm going to spend all the money, and you look at them going, for example, it's a school, and you're going like, by the time you've gone through planning things, you're not going to be doing anything until Christmas, sort of thing. And it's experience, and it's getting through to project managers and getting them. We are getting better. We are building it into the model, but it is a learning process, and there'll probably still be big swings, but we are working to try and get it better and factor it into the capital and treasury models.
Just in defence of the officers, and really just making this is like very much a thing, maybe as an independent member I could say, there is also the competing pressure for officers, however, from cabinet to have a maybe overly ambitious capital programme. You as politicians will be able to, speak to this. You're under pressure from residents to be seen to be delivering, and they want to see their capital scheme in that capital programme. So it's a competing pressure for officers where they're having to then maybe put forward a capital programme that they know is overly ambitious, which they're then going to have to inevitably reprofile, which then leads to slippage and shows slippage. So I point out as just like it's a difficult, not necessarily like an easily solvable one because of the structure of like local government.
Andrew, and then
can I just respond generally? I mean, it's really helpful to hear all these comments, but I don't want you to leave this meeting with an impression that we don't do many things. We do stress testing and scenario testing. We know that there are known unknowns. And the primary way that that's sort of modelled in is the interest rate risk, and that is definitely part of the stress testing, individual and all individual schemes, I should say. We of course keep an horizon scan as a council on policy developments. I apologise if I personally am not as up to speed as perhaps some of the other people in this room, but that is something that is managed across the council, and they would be aware of policy changes. Of course, the professionals in the relevant disciplines do take that really seriously. They do that. We completely, in part thanks to the more long-standing members of this committee, really, but we completely aware of the slippage and the forecasting issues on the capital programme. We do not set out, and we certainly do not borrow money just on the basis of ambitious individual budget holders or, people who are sort of very optimistic about schemes, we layer in a level of, the opposite of pessimism. We layer in some pessimism bias to avoid that, on a sort of percentage basis, basically. The forecast is saying this, there's no way we're planning to borrow that. We are, on the empirical evidence of previous years, making plans to borrow less than that. So, I really welcome all these discussions of risk, but I didn't want you to be under the impression that these things aren't being thought about and aren't part of the process. They absolutely are. We really welcome the comments. We'd like to do more on it, but we are acting on them.
Thank you very much. Councillor Paul and then Councillor Allam.
Chair, to be helpful to the comment, obviously slightly in danger of going into housing scrutiny, my colleague. But to be helpful, a recommendation could go from this committee to the Housing and Regeneration Committee. But they look at the issue of slippage and they look at risk of non-delivery in our regeneration and housing schemes. The chair of that committee is Councillor Letzer Hudson. And what that chair of that committee could do is have a conversation with the chair of the Overview Committee, who's also Councillor Letzer. Between the chair of the Housing and Regen Committee and the Overview Committee, they can have a conversation with themselves in the mirror, decide how this organisation assesses risk of slippage. Technically, it's not the purview of this committee to be looking at in the slippage on schemes or model viability. I think that would be a constructive way, Chair, of capturing the really great comments we've just had, to go somewhere and to be of value for your work.
Agreed. Noted. Thank you. Councillor Allam.
Don't understand one line of this. I think it's called capital expenditure. 554 million in 2024.
So do you have the section or the subsection or page reference for our colleagues, please?
Also in Appendix 1. I think it's. It's also,
capital expenditure.
The section.
Oh, it's on page 21.
Page 21.
Yeah. In 2021.
21.
Your forecast of 419 million.
Yeah. Forecast 419 million. That's it. How realistic is that, and how are you going to reduce the expenditure?
Apologies, I'm still.
It's a
I don't have
of Appendix 1.
Appendix 1. Thank you. So what that bullet point is saying that at the time of writing, the latest forecast for capital expenditure was 419 million. I spoke earlier about that, half of that being within the housing revenue account, and half, in the general fund, essentially. The question was, how are we going to reduce that? We're not really going to be reducing that actively. It may be that we end up spending in 25-26 a sum less or greater than that, but that is the forecast. I suggest that recent years' experience would be that we'll come in a bit under that, but it's not sort of finance endeavour to reduce capital expenditure. In many cases where we're spending money, that creates a saving to our revenue budget, or it creates a return.
Less projects, less building, what is it?
Well, this is simply the forecast drawn from all the individual budget managers or program managers for the many different schemes in the capital program, and that's the aggregate spend for this financial year. So that's simply what that number is. We'll report in the summer what the actual outturn for that is. That's just a forecast. We'll give you the actual results in the summer to close the accounts.
Councillor Nuri?
Sorry, I forgot I did actually have a question about this, but it's not like a, I'm not scrutinizing, it was just a clarification. Where you say that the 554 million in 24-25 came, that 163 million of it came from right of use assets. And so the actual capital expenditure was 391 million in 24-25. Is the ROU also included in the 419 million, or is it absent from that? And would that then mean that we spent more in 25-26?
For clarification, the right of use assets, this is to do with the capital finance requirement, is the leases that came back onto our balance sheet following the introduction of IFRS or adoption of IFRS 16 by our accounts.
So that's the.
But that's only for 24-25?
Well, to be included going forward, it'll change.
Okay.
It'll change each year.
It's the international financial regulations
Reporting.
It's like International Financial Reporting Standards 16. So it's a change in accounting treatment. It means no cash is changing. More plain English, we do rent things, but the standard there that we have adopted and that the whole of local government sector has now adopted only 5 years after everywhere else, it makes you sort of recognise that you are using those things you are quote unquote renting, and you need to recognise that they are an asset. Basically, perhaps renting is the wrong word really, because you are effectively buying that asset and controlling it over time. So it needs to come onto your balance sheet. So it's a bit of a one-off. That's why we
sold issue.
Yeah.
So where you okay, fine.
Yeah, so you won't see that repeated.
It's in there.
Once they're on our, now we've adopted that accounting standard. As we move forward, you won't see a big change like that.
That makes sense. Thank you.
Sorry, that was a garbled explanation. We'll try and do better.
Any further questions from members? Then before we move forward, could I just have it noted that any changes or amendments that are made following today's session, could that be shared with members in writing? I appreciate that at the Cabinet it will be available publicly, but if we could kind of get that actively out to members, that would be much appreciated. Okay, great. So may I see by show of hands, is the report noted? Thank you very much. And thank you, members, for very thoughtful questions. I really appreciate that. And thank you, officers, for explaining acronyms, which is always very helpful in our comprehension. Okay, moving on to item 6, which is the year ahead forward plan. Are there any questions on the forward plan? No. May I see by show of hands, as the report noted? Thank you. Item 7, date of the next meeting. The date of the next meeting is scheduled for the 25th of February, 2026. This is a changed date, so please ensure that your diaries reflect that with the 25th. Also, please note that the start time is slightly later in the evening. It starts at 7:30 p.m. May I see by a show of hands, is that date noted? Thank you very much. Item 8 is around exclusion of press and public. So in order to freely consider item 9 on the agenda, I would propose that the press and public be excluded from the meeting to the extent that exempt information as described in part 1 of Schedule 12A to the Local Government Act 1972 is likely to be disclosed. Is there a seconder? Thank you. So may I see by a show of hands, is that agreed?
Agreed.
Thank you very much. Well, then that concludes part 1 of tonight's business. Before we go into the private session, I would like to say thank you and wish a good night to everyone who is watching on YouTube. And can I remind members and officers to please wait for the clerk to verbally confirm that the live stream has ended before we move to the next